Welcome to this In Conversation webinar with Mohamed El-Erian, Professors Hélène and Richard Portes on finance and the economy in the COVID-19 world and beyond, brought to us by the AQR Asset Management Institute at London Business School. I'm Joseba Martínez, Assistant Professor of Economics here at LBS, and I have the pleasure of moderating the session today. Welcome to everyone joining us from across the world, from the LBS community and beyond. A very warm welcome and thank you for joining us today. I'd like now to introduce my esteemed colleagues, Hélène and Richard Portes. Without further ado, Richard.
Thank you very much, Joseba, and thank you very much, Mohamed, for joining us. We could not have imagined at the beginning of January that it would be under these unfortunate circumstances. But here we are. A lot has passed in these less than 6 months. The world, the economic world, has changed dramatically. We are in the midst of the greatest fall in output, the greatest rise in unemployment since at least the Great Depression, 1929 onwards. And that has had huge effects on households, on firms, on the financial sector, on international relations. And I think we're going to touch upon all of those issues in the discussion, the conversation that we're going to have in a moment. But first, I think it might be interesting to have a little poll of our audience, which is growing steadily as I watch. On my screen, the number of participants is mounting. But for those who are there already, here's the question for you. Do you expect a financial crisis in the next 5 years in at least one advanced economy? Simple yes or no. And you've got 30 seconds to reply if it really requires meditation. But it's straightforward. You might want to quibble about what a financial crisis is and what's not, but I think we all have a fairly good idea. And we now have very quickly the results. This is not good, Mohamed and Hélène. This is not good. Our audience is saying that they expect a financial crisis in the next 5 years in at least one advanced economy. We didn't ask the audience what country, what economy that might be. You might wish to touch upon it, but I will turn it over to Hélène to start with a question, a rather different question, but we might want to get back to that issue at some point. Hélène.
Thank you very much, Joseba and Richard. Hi, everyone. It is a great pleasure to have Mohamed El-Erian with us today. So Mohamed is Chief Economist Advisor at Allianz, and he was CEO and co-CIO of PIMCO before. He has served as chair of President Obama's Global Development Council, and he was also a deputy director at the International Monetary Fund. And Mohamed will actually be the master of Queen's College, Cambridge, starting this fall. Now, personally, I have met Mohamed numerous times in many academic conferences and policy conferences. And I have always not only learned a great deal from him, but also I have always tremendously enjoyed our interactions. So I'm very happy that you are here today, Mohamed, and thank you very much again. So to set the stage, I thought it would be good to start by discussing whether and how this big, massive COVID-19 shock has been indeed changing our world and possibly changing the paradigm of international investment and international trade. So this shock we are going through is really massive. It's bigger than the 2008 shock. It's also of a very different nature. It's not a financial crisis shock, at least not yet. It's not due to financial excesses. It involves a great lockdown of the economy, as the IMF calls it. At LBS, actually, we call it the great cessation of economic activity. So how do you see this shock, Mohamed, playing out if we think about the future of globalization, if we think about supply chains, if we think about also international investors? What is your view? Is it really a change in paradigm that we are living through right now?
Thank you, Hélène. And let me thank you and Richard and Joseba for having me on. I must tell you, it is a pleasure, but it's also incredibly anxiety creating at this end. I'm looking at people whose work I cite continuously, and it's an upside down world. If you are interviewing me, I should be interviewing you. And don't be surprised if I throw back questions at you, because I follow your work closely. So when I feel that you are much better equipped to address this, I will do so. But I won't do it all the time, because otherwise I will end up by interviewing you, and that would break our implicit contract. Look, think of us as having embarked on an unsettling journey to an uncertain destination. And think of the destination being itself a function of the journey. So the complexity of the situation we're facing is unmatched. And that is just the economics. I'm going to come back to other layers. So what's happening to the economics? I think the supply side is clearer than the demand side. We are shocking the supply side in such a way that unless we get different policy responses, we will emerge from this shock with lower growth, lower productivity, more debt, and higher deglobalization. Let me start with the deglobalization. This is the third shock to globalization in 10 years. The first shock came in 2010. It was household-led. It was a pushback against the alienation and marginalization of certain households. The answer to that was make capitalism, make globalization more inclusive. The second shock came in 2017, 2018, started out as the unilateral pursuit by the US of a fairer trade system. It is now in a spaghetti bowl with national security issues, domestic political issues. This shock is not going to be household-led. It's not going to be government-led like 2017, 2018. This is going to be led by all three segments of society. Corporate sector will be shifting from efficiency to resilience. And already in the US, we're seeing a lot of talk about localizing supply chains. Governments have entered into a blame game that is going to intensify because it deals with global responsibility. And the household sector in the US in particular, this labor market is under enormous pressure. We saw that again today. And I don't see unemployment coming down well below 10% anytime soon. So this is a major deglobalization. As we rewire the world, that is a negative productivity shock. We're going to come out with this a lot more industrial concentration. The large are getting larger. Small and medium size is under tremendous pressure. And we will have more industrial concentration on top of that. So if you look at the supply side, it's hard to see us not going into a period of even lower growth and even lower productivity. And that's bad because there is a socio-political angle to this. It is also a great inequality driver, this shock, and not just inequality of wealth and income with the poorest segments of the population most vulnerable, it's also inequality of opportunity. I can tell you stories about people my daughter's age who are at home and are finding it very difficult to keep up with online education. They don't have often the Wi-Fi. They don't even have a private space. This is devastating in terms of the inequality of opportunity as well as income and wealth. And there's a good reason why you are seeing the political movements, the popular movements on the street right now. So add to economics, a socio-political angle, a geopolitical angle, and then on top of that, markets completely disconnected from all this. by central bank action. So this is complexity in a big, big way, but none of it is good news, even though there are certain silver linings that I think we should talk about, but none of it is good news and will require a massive policy response and will require a lot of adaptation from the corporate sector.
Let me pick up on one thing you said. There are many things there to go at, but right towards the end, the decoupling of markets from the economy, in a sense, and the role of central banks. I was in a meeting this morning with officials who, one of whom simply said, well, we've got the Greenspan put out there in a new form, and that's what we have to live with. And it may make us uncomfortable, but that's the way the Fed set things up. And what do we do now? What do they do now?
So first, what they did up to a certain point was welcomed and necessary. And that certain point was until they had restored the full functioning of markets and until they had opened the bond market wide open to investment grade issuance. The Fed, however, went one step further, an unimaginable step in my mind. They entered the high yield market. And by entering the high yield market, they underwrote default risk. And once you underwrite default risk, good luck convincing the equity market that they will not be bailed out. So they went, in my view, they went too far. So the first question mark is how do you somehow try to take back? Because what we've seen with these unconventional policy, they belong to the no exit paradigm. Once you're in it, it's almost impossible to exit. Look at negative interest rates in the case of the ECB. Impossible to exit. Why? Because the market holds you hostage. Now you could say that's fine because the alternative would have been worse and we'll be able to manage through it. And for those of us who are very involved in the marketplace, let me tell you what is going on. No one cares anymore about risk. We have record issuance of high yield ahead of record bankruptcies. We are seeing the notion of the Fed umbrella extend not only to what the Fed is buying, but extend to emerging markets. We are seeing excessive risk-taking by investors, excessive debt issuance by companies and sovereigns. In the process, we are zombifying markets. The market signals today are so distorted that it is worrisome that they are mobilizing and allocating capital on such distorted basis. So for those of us who do not think that, to use game theory terms, and I'm sorry to use game theory, this is not a game, this is very serious, but I have found game theory incredibly informative. This is not a one-round game, this is a multiple round game. And you're entering the domain of monetary policy where there is no plan B. And that's not where you want to be. So I am sympathetic with central bankers up to a certain point, but I think that they've given markets too much of a good thing. And markets are like little kids. You give them something, they immediately internalize and they want more. Yesterday, the Dow Jones went down just over 2%, and already there was speculation in certain market circles. What will the Fed do now?
Yes, so I think that was an extremely important point that you made. And so to rebound on it, and as you mentioned them, so when there was support for high yields and indeed in a way, so supporting possible defaulting entities, you also mentioned emerging markets. And to some extent, it has been almost surprising that the market has not completely closed for some emerging market. It has closed and then it has reopened somewhat. Even though we know that the shock that is hitting those economies is extremely hard, so maybe that's actually, that was relief for them to be able to borrow a little bit more, given that they have been cut off in international trade to some extent because of the decrease in international exchanges, remittances have gone down. We also, a lot of them are dependent on commodity prices, and the price of those has gone down. So it has been a terribly hard shock. So for those markets, maybe the generosity, if you call that like that, of the central banks has been actually supportive, and maybe in their case, that's a good thing. Do you think so, or is it just, you know, one of these situations where there's going to be debt being accumulated and an even worse default down the road? What's your view on that?
So first, we should not underestimate the shock to developing countries. It's everything you've listed, plus tourism, plus foreign direct investment. So it's virtually every aspect of the balance of payments that's being impacted. And that was in phase 1 and phase 2 of COVID-19. Phase 1 being China, Korea, etc. Phase 2 being Europe and the US. And these countries were struggling to deal with the spillovers. Now they have their own situation. And they don't have the policy flexibility, so they can't apply the same rules. So yes, it is a good thing that they've had access to financing. However, again, what if it's another one-round game? What if this financing is not going to activities that are temporarily disrupted and coming back, but going to activities that are long-term disrupted? We will emerge with more debt, less growth, and what I think for many developing countries will become a paradigm of non-payments. Now, the trouble with a paradigm of non-payments is that it's very difficult to make it orderly. It's very difficult to make it orderly because, unlike the Latin American crisis of the 80s, it is not a handful of banks. You know, the G20 did something very important. They deferred debt service payments, and that's a very good thing. And then they said they expect the private sector to carry part of the burden as well, fair burden sharing. But then when it came to implementation, they quickly realized there is no top-down mechanism. And because there's no top-down mechanism, it has to come bottom-up. And unfortunately, we haven't yet discovered a way to do it bottom-up without the threat of imminent default. And that threat of imminent default causes all sorts of other disruptions. So this is not, yes, the debt again may have forestalled liquidity issues, but it hasn't, it has accelerated solvency issues. And that's what I worry about, Hélène. So again, the problem, you know, when you hear the phrase, whatever it takes, but when you hear the phrase all in comes from poker. All in is when you are in the final hand and you go all in, right? And all in makes sense if it's a one-round shock. It doesn't make sense if it's a multi-round shock.
Okay, maybe we switch a bit to the real economy. Hélène, I know you were concerned about China and its role in the global economy, how that changes under certain. What was in particular in your mind?
So yes, and actually this is also related to the discussion we just had on emerging markets, because I think one of the big transformation we have seen in the international economy in the recent years is not only that China has been a big actor in global growth, so this we have seen for a while, but maybe China has also become a systemic actor on global financial markets via, in particular, its investments in emerging markets, in emerging economies. And as we know, I mean, the official data do not fully reflect the extent of this engagement in emerging markets, but there is a lot of lending from China to some developing countries. Some developing countries actually owe huge amounts to China, up to about 10% of GDP in some cases, in contracts which are of commercial types contract as well with collateral. And so if we are, if we are as pessimistic as you've just described, Mohamed, with the emerging world, and we are witnessing a situation in which we are going to see potentially some difficulty in emerging markets and potential defaults coming up. So China will be the elephant in the room there. How are we going to engage China? How are we going to be able to restructure debt not only the private sector, but also with China and these different types of lending?
So the government of China signed up to the G20 approach, and just this week in Angola, it provided debt relief. And just to highlight your point, Hélène, your right point, China is 50% of Angola's debt. And what we saw is an absolute explosion of Chinese financial links, especially under the Belt and Road Initiative 1.0. And what was different about this bilateral debt is, like you pointed out, not only was it commercial, but it was very cleverly structured. There's a reason why China ended up with a port in Sri Lanka. There's a reason why China ended up with a port in Djibouti, and the examples go on. There was a pushback against BRI 1.0. And BRI 2.0 is much less onerous for the debtor than 1.0 was. But you have to deal with the stock of 1.0. And it's going to be very interesting to see how China does this going forward. I think the international community expect uniformity of treatment, expect China to be part of a Paris Club approach, both for its sovereign and its quasi-sovereign claims. But time will tell. So far, China has been playing according to this, but it hasn't been easy. And what people are finding out very quickly is there's a lack of information, not just on the stock of debt, but on the terms of the loans.
So maybe I could take us back to the financial sector, which is, after all, your natural habitat, and raise some questions about the reforms that took place after the global financial crisis, which were extensive. Some of them have been rolled back, especially in the US, but they were fairly substantial. And at an international level too, in Basel and so forth. Have those reforms made the financial system more resilient significantly? Or were we really rescued from meltdown in those turbulent days in March only by central bank intervention? And would, despite that new resilience, supposedly, would the system have gone down in one way or another had there not been that intervention? Forget about whether it was high yield or not high yield. They could have left that bit out, but the markets were seizing up. Could the Fed have, and could the central banks have let that happen? And if so, what happened to this? What about this great wave of reforms that was supposed to make the system function so much better?
The big lesson from the global financial crisis, and that applies not just to the financial issues, but the economic issues, is that the world won the war against a global depression, but lost the peace. It failed to enable a peace of high, inclusive, and sustainable growth. And this is really important because it has lessons for this crisis. What did that look like in finance? We won the war against a complete counterparty failure, what I call a heart attack to the global system, because the counterparties involved were the banks. And when your payments and settlement system is in play, both of you have done a lot of work on this, you discover that A, it paralyzes everything else, and then it becomes, to use the words of Hélène, a common global factor. It disrupts everybody because the payments and settlement system no longer functions. And the winning the war bit was not only ensuring that the payments and settlement system worked again, but making the banks safer. And in most jurisdictions, that has worked. And the proof of that is that the banks this time around are part of the solution, not part of the problem. But we didn't secure the peace because we didn't understand something very fundamental. Financial risk has a way of morphing and migrating. And it morphs and migrates because people make a ton of money out of it. That's simple. And what happened is that the risk, the systemic risk, morphed and migrated from the banks to the non-banks. And unfortunately, the non-banks don't have the same amount of supervision and regulation. And we saw the non-banks embark on a massive sale of liquidity. The system overpromised liquidity. To show you how crazy it is, people were stretching for yield so far that they were willing to buy ETFs on illiquid asset classes. Now, an ETF by definition is an implicit contract to provide instantaneous liquidity at reasonable bid-offer spreads. You need the underlying liquidity of the marketplace for that. Did you really want to offer high yield on ETFs on emerging market corporates? But that is how crazy it got. So when we had the crisis this time around, we dealt with the consequences of overpromised liquidity. And as you say, Richard, the system almost came to a halt. And we saw that illiquidity migrate up from the lower asset classes all the way to treasuries. I remember the Thursday before the massive announcements over the weekend and then the following Tuesday and Wednesday, when the US Treasury market, the mother of all markets, was not functioning. That had nothing to do with banks. It had to do with non-banks. So yes, we secured one part of the financial system, but we didn't realize that the risk had morphed and migrated to another part that we hardly understood. Regulators didn't understand non-banks enough. And that's why I'm going to keep on coming back to this notion of this time around, we've got to win both the war and the peace, because otherwise we will go into a next financial crisis much, much weaker.
I think the banks are sufficiently strong that they can take the hit and keep on providing credit to the real economy. One of our concerns, at least in Europe, is that the banks don't want to use the various buffers that have been built in since 2010, and they want to retain the buffers because they're afraid that if they use up some of their capital, then they'll be forced to bring it back, get it back quickly, and goodness knows what might happen then. And they're reluctant to lend in current conditions, even when you have government guarantees, or at least 80% government guarantees, say. Well, that 20%, what about that 20%? And so we are not seeing despite the liquidity that's being provided to the banks, despite the buffers that they have in their capital position, we're not seeing them extend significant amounts of lending.
Yeah, I mean, I think there's two understandable reasons for that. Look at the IMF analysis that came up yesterday and today. If you look at that, if you're a bank, you'd be very, very, very careful about credit risk. Very careful, right? So, you know, the banks have understood more than governments have that this is a multi-round game, and they're trying to stay in the game. And they're trying to strike that balance. I actually have less sympathies for, at least in the UK, banks have stopped dividends payouts and buybacks. In the rest of the world, they still haven't done that. They haven't stopped that.
So overall in the EU, there have been directives to the banks to stop both dividends and buybacks and restrain managerial risk takers' compensation bonus.
Right, but in the US we haven't as yet. It'd be interesting to see what the Fed says today. The other thing we have to realize is that governments have no plan B. This is a very strange situation. So if you are in the policy structure of an economy and you run out of policy room at the central bank and at the fiscal authority, we're not there yet, but if we do, the next thing you do is you start treating banks as utilities, right? So we, you know, there's a certain waterfall that the system goes through, and the experience of developing countries is incredibly informative. I often tell people that policymakers in the advanced world would really learn a lot from looking at what has happened in developing countries, because unfortunately, the more we go through this repeated crisis situation and weaken the underlying integrity, structural integrity of the economy, the more we become more like a developing country in the way policy has effect or not.
You touched upon something that I think is extremely important and has been to some extent discussed, but not enough, in my view, and that is the loans that are going out and the arrears that are building up for lots and lots of firms won't they lead to a lot of firms simply being unable to pay back? At which point, what do we do about transforming, first of all, about triage, about saying, you mentioned it earlier on, some firms shouldn't stay on, right? But the others, if we think, and who's going to make that decision, if we think that they should stay on, how are we going to transform that debt somehow into equity? Is this going to be a really big shakeup in capitalism as we know it?
That's a function of the journey, of the length of the journey. We are now trying to live with COVID. And what we're discovering, rather than use the letters, because the letters get very complicated, what we're discovering is this image of a pendulum. It used to be on this side, normal functioning economy. We violently and suddenly swung all the way to this side, paralysis, economic sudden stops. Now, we are somewhere in between, and we're still trying to find what the resting point is. So, the United States is a perfect example. We have run a natural experiment. I don't advise anybody to run the natural experiments that we have run, but we have had states at 3 different speeds. We have a set of federal guidelines. We have a set of states that basically ignored the federal guidelines. We have a set of states that are more prudent than federal guidelines, and we have a set of states that are in line with federal guidelines. The result of which is very different outcomes. The result of which is, think about this. Yesterday, the eastern states used sand in the wheel, what the 3 of us will call sand in the wheel measures, to limit mobility between states. So we do have this issue of trying to find the resting point. The longer it takes us to find this resting point and see it improve back, the more we are going to start going to a paradigm of non-payment. There's already a significant amount of non-payment going on. And we are entering this paradigm without principles. I remember when the decision was made in the United States to bail out the airlines. The view was the airlines are the exception. It turns out the airlines are not the exception. It turns out that the airlines were a leading indicator. But now, who do you bail out? Who do you not bail out? There are no principles guiding this yet. So it's really important. And I understand why, I worked at the IMF for 15 years. Both of you know, in a crisis, you don't let the best be the enemy of the good. Because if you lose time, then there's massive damage. But you also learn in a crisis that you have to look carefully at what you've done and course correct, because you will make a mistake. All of us tend to make mistakes in crises because we don't have full information. But we have to course correct and adjust as we go along.
So precisely on this and in this terribly difficult journey that you mentioned and talking about winning the peace, so are we concerned that all the progress we had made towards green investments, towards ESG, we were on a course where we were actually trying to actively do something before the COVID shock hit, a lot of private sector initiatives along those lines, etc. Are we concerned that because of this terrible shock, we are heading for mostly a brown recovery with no principles, no values, as you just put it, and that we're actually setting back the ESG agenda like massively, and we're not learning anything from the past?
So depending on the day, I'm either optimistic or pessimistic. I'm going to throw it back at you, Hélène. I'm optimistic because I think there's much greater awareness of tail events. So even those who denied climate change view it as a tail event, there's greatest awareness. There's also much greater empowerment of the street and of young people. And we are seeing that also being reflected in certain outcomes politically. But on the other side, there is a real risk that this issue gets crowded out, because this issue, while very, very important, some view as not urgent enough. And we all know that the urgent and important can crowd out the important but not urgent. So let me ask you, help me. Should I be optimistic or pessimistic, Hélène, on this?
Well, Mohamed, that's a tough one. That's why I was asking you the question. I'm guessing that to some extent, the answer will have to depend on which countries you look at and which region of the world, because we are talking here about political governance. It is a fact that everybody is worried about jobs. Capital has to be relocated across sector, because some sectors have to shrink because of the shock. Other sectors will have to expand. You have to, in such times, I mean, the good governance will be to try to give the right price signals, so that, the green sectors would expand and the brown sectors would shrink. But in order to give the good price signals, you have to put in place a number of institutions that you can rely. We have to put in place a number of, for businesses themselves, to harmonize reporting along lines which are much broader than financial reporting. And this is something that, if we look around the world today, we clearly see that some areas will be more advanced than others. So probably the view is mixed, but like you, I'm very much hoping that, we are going to see some progress at least somewhere, and to set the standards, and hopefully that then globally we will get there. It's a question of survival, as we all know.
The pessimist in me says, why is it that governments haven't seized the opportunity of the huge fall in oil prices to raise taxes on petrol or gasoline, so as to effectively keep the market price up? And as I say, take an opportunity that many people say they should have taken a long time ago, but it would have created inflationary pressures and so on. Now, you could do it, and it would hardly be noticed. But we're not seeing that. What we are seeing, and Hélène, you might have a word on this, is that the proposed European Recovery Fund is supposed to have some emphasis on ESG, on environmental issues, isn't it?
Absolutely. So in Europe, the Green Recovery Plan is going to take effect. So hopefully in 2021, there will be some first projects being funded across Europe. And the emphasis is both on green recovery and also on digitalization. So let's see how it materializes. But I think it's time now to open. Yes, of course. Yes.
I mean, because you both touch on both a silver lining and a less optimistic. The silver lining is we're seeing Europe do things that it hasn't done for a very long time, and that is a silver lining. And I think that is very good for Europe. The less encouraging is that if ever there was a global shock, this is a global shock. And yet we are seeing the lowest amount of global policy discussions, let alone coordination, than I have witnessed in my career. And I'm an old person. So it's good that we are seeing better regionalism in Europe. It is depressing that we are seeing virtually no global policy coordination, which speaks also to your point about climate change.
Thank you, Mohamed. Thank you, Hélène and Richard, for a wonderful discussion. And thank you to our audience who have sent in a great many excellent questions. Some big themes emerging. Lots of concern about monetary policy and where that's going to take us. Lots of concern about whether inflation is around the corner, and more generally, lots of concern, unsurprisingly, about what markets are up to, and some people asking for stock tips, but I won't ask you for stock tips today, Mohamed. Let's start with monetary policy. So someone asks, what could be the end game for the ballooning central bank's balance sheet and growing government debts? Where's the limit? Can this QE dynamic continue for several years, and what could derail it? And perhaps we start with Mohamed, and Richard and Hélène, you tell us what you think as well.
So Hélène will remember, because we were at the same conference that gave me an idea for my 2016 book. called The Only Game in Town. And it was clear then that there was only one orderly way out, which is a handoff. The central banks have to step back, and they can only step back if other policy makers step up to their responsibility. Central banks cannot act unilaterally, and they won't act. You have to understand that a central bank is like a doctor. A doctor never walks away from the patient. And even if the doctor doesn't have the perfect medicine, the doctor will still try to do whatever they can. And she and he will prescribe the second, third, and fourth best medicine better than prescribing nothing at all. So central banks will not step back on their own. They need the handoff. And the handoff comes from much more serious structural reform policies that are pro-growth, pro-productivity, a much better balance between fiscal and monetary policy. In the United States, better safety nets, some debt forgiveness, because these debt overhangs are not going to be going away on their own, and better regional and global coordination.
I think if we think about government debt, so one thing to keep in mind is that we have seen in the past high levels of government debt after the Second World War. If we look at debt to GDP ratios of the US or the UK, we have gone way above 100%, in some cases close to 200% at this period as well. And somehow we managed to get out of that in a relatively orderly way through, as Mohamed said, mostly growth and without any major crises. A tiny bit of inflation in the case of the post-war, but mostly through growing out of this debt. So I think what we can hope for is that we will be able to reenact exactly the same pattern, which is a very slow decreasing debt to GDP ratio over many years, thanks to good macroeconomic policy management, and thanks to maintaining or increasing, obviously that would be the best, growth potential. But this is not a given, because as Mohamed also pointed out, the effect of this current shock on productivity might actually not be so reassuring if we look ahead. If we look about the effect on human capital, if we look at the effect on destructions in terms of bankruptcy in the business sectors as well. So this is where I think active policies and reallocation across sectors and training policies are going to be key in the coming months. And that only these types of policies will enable us to deal with this increasing challenge of debt to GDPs in most advanced economies.
The monetary policy issues here, I would just express some positive thinking about two things that some people have been expressing very negative thinking about. One is the size of central bank balance sheets. We were told in the first QE periods that building up these central bank bloated balance sheets, bloated was the big word, was going to be disastrous. Well, it hasn't been. And I don't think it'll be the expansion of central bank balance sheets in itself makes a big difference one way or the other. You may disagree, Mohamed. And the same people are saying, oh, and by the way, it's just setting us up for hyperinflation. We're going to have a big bout of inflation because of all these central bank purchases, putting money into the system, and it'll spill over into inflation. And just watch it. Again, the same people who were saying these things in 2009, 2010. But what's your view? Maybe you were saying those. I don't think so.
So I wasn't saying it then, but I'm more worried now because the scale and scope has changed completely, Richard. And what we're having is literally a spaghetti ball of public involvement in the private sector. And think of a spaghetti ball, okay? And think how difficult it is to untangle a spaghetti ball of such involvement. And I worry that what makes a market-based system so special will be eroded. But I'm curious to all three of you. If we were having this talk in January, and I would have told you in the next 4 months, we are going to run a natural experiment with modern monetary theory and universal basic income. Okay, A, what probability would you have given to that statement materializing? And B, how do you feel that we actually went down those roads in such a sudden manner?
That's one thing. I don't think this is what we're seeing as an experiment with modern monetary theory, but that would get us into a longer discussion that we haven't got time for. So I'll leave it to Hélène.
No, certainly I wouldn't have guessed that we would be doing the type of macro policies we're running now. But I would still maintain that the type of macro policies that have been done actually are the right ones, or were the right ones when the shock hit, and certainly for the short run, freezing the economies in order to withstand the shock was definitely the thing to do. And so I think we can actually be happy that policymakers have reacted so quickly. However, I think the danger is that, as you point out, we have to exit these policies, and we have to exit, in particular, all the policies in Europe which are about partial unemployment and which are about paying people, so the public money paying people to stay in their jobs, essentially. And so the big issue is how we can shrink the relevant sectors, expand the other sectors in order to create better potential growth, and how we can avoid that with how we can avoid massive unemployment while doing so, and preserving some room in terms of public finances. And this is an extremely tricky balance to actually strike right now. And everybody is definitely struggling with that among governments. So on this, I think, the fall is going to be extremely challenging.
You do that restructuring while maintaining the capitalist market framework that we have. I think that's a big issue going forward. The spaghetti bowl, Mohamed's spaghetti bowl, is going to be very difficult to disentangle without crossing a lot of boundaries that we, in principle, didn't want to cross. No? Mohamed, what do you think?
I think you're totally right. I think one is all the unintended consequences. And I agree with you, Hélène, that the first phase of reaction is correct. But I have this image that the patient has to be taken to the ICU and all the doctors are around and the doctors save the patient. And then there isn't the recognition that the patient just can't be let out of the hospital, that there are certain phases. When I said we won the war against the depression in 2008-9, but not the peace, the world economy came out structurally impaired. It came out of the hospital structurally impaired. And we forgot about these structural impairments. We thought that this was a mean reverting shock. This was a cyclical shock, a deep cyclical shock, but it was structural. And here now, the minute we talk about productivity, the minute we talk about long-term unemployment, the minute we talk about inequality, all the things that all of us worry about, these are structural in nature. So the doctors can't just leave the patient once they're out of the ICU. And that's what I worry about, is that political focus will go down and central banks will then come in, but they don't have the right tools. They can just give the patient painkillers. And we've discovered coming out of 08-09 that painkillers don't deal with structural problems.
Joseba, what else have you got for us?
So since Mohamed mentioned modern monetary theory or magical monetary thinking, as some would have it, let's talk about the great bugbear out there, inflation. What we keep telling people is that if we print money ad infinitum, eventually inflation will rear its ugly head. What is your outlook for inflation? Do we expect a spike? Have central banks given up simply on the mantra of inflation targeting? How do we square the market's cognitive dissonance of thinking, on the one hand, inflation must result from all the stimulus, but central banks haven't changed what has been the mantra for the last few decades?
So I'm actually want to hear the others, but let me tell you that the market doesn't care so much that a 100-year bond was issued 2 days ago, 10 times oversubscribed, 10 times at less than 1%. And all you have to imagine is what happens if inflation goes to 1 or 2%, what happens with the value of that bond, okay? So the marketplace doesn't think inflation is coming back. In terms of the economic element, again, I am torn. I don't think it's as much a threat because I am worried about the demand side. If you just looked at the supply side, you would worry because deglobalization, increased industrial concentration, the rewiring of supply chains, all this leads to higher inflationary pressures that I think will offset this amazing combination of Amazon, Uber, and Google that have basically eroded pricing power from lots of people. But the demand side for me is the big question mark, and I look to Richard and Hélène to help me. Are we going to come out with a more risk-averse consumer or not? Let me tell you what's happening here. If you go here to or talk to the local food bank, they'll tell you that the lines are not just long, but they are completely differently composed from what they've seen before. And the example they use with me is a baggage handler at our local airport. That baggage handler, in their mind, had a very stable and secure job and had no savings. And they were living paycheck to paycheck, but that's fine because the job was secure. Now that baggage handler is unemployed. And the question for me is when they become re-employed, will they live paycheck to paycheck or will they start saving more? I don't know how much of a change of the sort of Great Depression frugality do we get coming out of this. And that has a lot to do with the inflation side. So it's the demand side. And I'm sure Richard and Hélène have a much better feel for that than I do.
Well, just a quick response on that. I think it is, my view has been for the past couple of months, that this is the much increased uncertainty out there is going to induce and is inducing already precautionary saving on a big scale. And people are not running up their credit card bills, their credit card balances, they're running them down, and so on. So I think on that count, you're going to see, you are going to see a reluctance to spend. And you can't, you can try to, we're talking here about cutting value-added tax to try to get people out to shop. Well, I'm not sure that's wise in the circumstances. It may be right for them for households to rebuild balances. Maybe they had got over leveraged. I think the data suggests that they had, at least, maybe not in the US, although the US data are hit a lot. The leverage of households came down because so many mortgages were defaulted upon. But I think that's a big factor. And I can think of some other, I have thought of some other reasons why I don't think inflation is just around the corner. But I think that's the main one. Let's bring in investment. Sorry, in uncertain times that we're in, it's going to be very hard to rekindle investment, even in those sectors to which demand has shifted. Never mind the sectors, how many planes are going to get, how much new investment is there going to be in manufacturing aircraft? Forget it. And we can go on. So I think that's, if you look on the two main sides, aside from government, two sides of expenditure, households and corporate investment. And it's hard to see them pulling up in the next year or two, at least.
Yes, so I would agree that in the short run, the deflationary side of things, the other demand side is very likely dominating. And I think there are two reasons. So one is the precautionary saving behavior that was just described by the two of you. The other one is simply the fact that as long as we have also uncertainty on the sanitary side, people are going to be very reluctant to take risks, presumably. And we know that in the US, it actually may be an issue for a while, given the number of cases going up again. And we can, we have this amazing, in a way, almost, it's not a natural experiment, but it's the comparison between Denmark and Sweden, where there was a lockdown in Denmark, which was mandated, but not in Sweden. And despite that, essentially the consumption behavior in Sweden and in Denmark have been remarkably close, meaning that the Swedish households have been very careful in their consumption patterns. So I think because of these effects, it's very likely that in the short run, we have a rather deflationary effect, which is dominant. However, I think the real question is a little bit down the road, because I mean, as you mentioned, Mohamed, we have this pile of debt there, and there is a small probability, right? It's a small probability that the shifting in relative prices might affect inflationary expectations, that we start to see demand picking up at some point, so not in the short run, but in the medium run, and that will constrain central banks' behavior in terms of being able to purchase some of the flows of debt issuance. And if this is the case, then that's where the dangerous territory may start. So it's a small probability, but it's a risk that cannot be neglected. But that's not for the short run.
Thing I can tell you that one the central bank, European central bank governors that I was meeting with this morning, virtually, of course, like all these things, are not in the slightest worried about inflation. Not right now, anyway.
Okay, well, thank you very much, Mohamed, Hélène, Richard, for a very insightful discussion. And thank you so much to our audience who've sent a number of great questions. We haven't had time to get to them all, obviously, but we'll do our best to answer them in some other way, perhaps by email. And with that, I'll hand over to Richard for some closing remarks.
Well, it's not, I'm supposed to be summing up, but of course it's impossible to sum up a discussion that has been so wide-ranging and so rich, I think. And so much fun. It's this kind of intellectual exchange on major policy issues where sometimes we've disagreed a bit, which is fine, and stimulating. And that's what we hope, and that's what London Business School, if I may say so, tries to promote. And I'm sure your new home, Queen's College, Cambridge, Mohamed, has exactly the same ethos. And it'll be very, very good to have you over here on this side of the Atlantic in the fairly near future. So we're very grateful to you, and I hope we can renew this conversation in a room, in a real room, a physical room soon. So thanks a lot.
Thank you very much, Mohamed. It was fantastic. Thank you, Joseba.
Thank you to our panelists. And sorry, Mohamed, we'll hand over to you for the last word.
Thank you. It was really a privilege and an honor. And everybody out there, please stay safe.
Absolutely.
Thank you to our wonderful audience.